During the Battle of Stalingrad in 1942, Joseph Stalin issued Order Number 227, which became notorious for its line, "Not one step back." The circumstances were so dire, and Stalin knew he could not lose control of his namesake city, so he declared that the Soviet army must defend the city at all costs. This is how I think about my trading. Under no circumstance can I go backwards. I will do anything I can to protect my account. I refuse to take any actions that could potentially do major damage to my account. While this may sound logical, it is the exact opposite of what most beginner traders do. In an effort to get rich quick, traders plow into a stock without any real consideration of the long-term consequences of such actions. It always boggles my mind that most new traders will put more time into buying a new phone than they do into planning out their trades. The problem is that these traders are caught up trying to go forward, but the key is actually to not go backwards. Let's pretend you and I decide to enter into a competition to see who can build a taller stack of wood. I decide I'm going to put a lot of effort into this. I spend 2 weeks building a huge hole in the ground. From the bottom of this big pit, I will then stack my logs of wood. You, however, take a break for those 2 weeks and do nothing. You come back refreshed and are actually ahead of me when we start because I went backwards. Even though I worked harder, I did myself in through my overaction. It's the exact same thing with trading. Let's say there are two traders, Trader A and Trader B. Trader A gets very aggressive and puts his entire account into a stock he believes is a can't miss. Things turn against him very quickly, and soon he sees his account cut in half. Trader B, on the other hand, does not want to go backwards. He uses stop losses, and after a series of losses, finds his account down only 7%. After a few months, the market starts to rally, and both traders begin to purchase stocks again. Trader A is on a roll and actually doubles his account. Trader B has some nice trades as well and is up 20% during this same time period. But here's the deal. Trader A is only at break even. The issue is he dug himself a huge hole. By having a 50% drawdown, he had to double his account just to get back to break even. Trader B understood that the key to trading successfully is to not go backwards. He used stop losses and risk management strategies to keep his account intact. Because he only had a 7% drawdown, he is now profitable with his 20% gain, while Trader A is still at break even. Trader A actually outperformed Trader B during the last few months, but his inability to keep his account intact totally did him in. Don't be like Trader A. Make a commitment to keep your risk in check. The numbers simply do not lie. Huge losses can severely damage your account. The next time you plan to execute a trade, remember, the key is not to leap forward, but to never fall one step backwards.